full 100 points now. So 17,900 plus is what we have on the index. So this is looking, so we got a 300-point fall, right, on Friday. And this is a 100-point bounce that we have. But I would suspect that this is the first act in what will be many acts through the course of the day, right? I mean, this is the first serious bounce. But let's see if this holds or this gets sold into. I would suspect at some point it gets sold into, and then maybe, perhaps a little more durable kind of bounce starts to set in. But 17,892, it was a damaging fall on Thursday and Friday, and we're coming out this week in at least some stability. I mean, it's not a big bounce or anything, but just stable markets and not a continuation of the big momentum that we had on the downside. Sonia.
Okay, well, whether the markets fall or not, one thing is for sure that people are going out there and buying, right? They're buying homes, they're buying cars. There's that K-shaped recovery that everyone's talking about, where the luxury homes and cars are being bought. But the lower end of the spectrum is still dealing with, loss of jobs, perhaps lower employment, as well as, rural income has not come back in a big way. But to get a sense of which way things are headed, Keki Mistry, Vice Chairman and Chief Executive Officer at HDFC, joins us now. To just give you a sense, HDFC had a fabulous quarter gone by, of course, reflective of what happened in the sector itself. It was the best asset quality that HDFC had reported in the last 11 quarters, and loan growth was very strong. Mr. Mistry, good morning to you, and always a pleasure speaking to you. Merry Christmas and greetings of the season. How do you feel about the year to come? I mean, we've spoken ad nauseum about how things are going to shape up, but it was a very good year for the real estate sector. What are the big triggers lined up for the new year?
So first of all, let me wish you, your viewers, a Merry Christmas and a very Happy New Year.
Thank you.
I think the year ahead, the last year has been a very good year for the financial sector per se, but also for the housing market. There are several reasons which have contributed to that. One is COVID made it more imperative for people to look for bigger and larger homes. Secondly, in the period from 2016 to 2020, property prices did not increase at all. And therefore, we were in a situation in 21 and 22 when home prices were more or less the same as they were in 2016 with much higher income levels, which led to a significant pickup in growth. And once the momentum started, the momentum has continued unabated till the time we speak today. Now, the structural demand for housing in India will always remain strong. I mean, it's not a 1 year, 3 year, 5 year, 10-year view. It's a very, very long-term view. For various reasons. One is very underpenetrated market. Mortgages in India are just about 11% of GDP, which is amongst the lowest in the world. Affordability has improved a lot over time because prices have not moved up in line with the way incomes have moved up. So all in all, the outlook for the sector remains bright. The government also has been very focused on the sector by providing fiscal incentives and a variety of other things, the credit-linked subsidy scheme and so on and so forth, all of which has benefited the sector. So I would expect the growth momentum to remain strong in the years ahead.
Mr. Mistry, one thing which gets talked about when we talk about the real estate sector is that it usually, when you turn a corner and start a cycle, up cycle or down cycle, it lasts for a number of years. We are perhaps already into year and a half, 2 years of this one. Do you have more visibility now of how long this momentum may last, or just some qualitative aspects around your thinking?
I think as long as the feel-good factor remains strong in the economy, I think the demand will continue to remain strong. The primary factor is that the family must like the house, the job should be secure. All of that has contributed to the growth. Now, if you look at attrition rates in many of the companies which employ a large number of people, attrition rates have gone up over time, which means that there are job opportunities. And when there are job opportunities, when your salaries are increasing, you have that confidence to, take the plunge and look at buying a house. So as long as the confidence remains high in the economy, I think the growth will remain strong. And I honestly believe India is so well positioned at this point of time that the growth momentum for industry as a whole can continue unabated for very long.
Now, Mr. Mistry, you recently also started funding self-employed category for housing. You talk about salaries, attrition, etc., but we've seen a rising trend of people starting out on their own, being part of the gig economy, etc. as well. But if we look at HDFC Limited's history, you can be called a relatively late starter in that category, perhaps on account of your own, risk-reward sort of framework that you had. In that case, in this self-employed category itself, do you think there could be competition with incumbent dominant players already? I mean, what's your strategy there?
All right. So first of all, let me tell you that we've always been lending to self-employed people. It's not that we started lending now. We've been lending to self-employed people now for decades, for two decades or more. But roughly, I'm giving you very, very approximate numbers, roughly about 80% of our loans are to the employed category and roughly about 20% are to the self-employed category. Competition is there in the market. Competition is there for any kind of business. But because the growth opportunity in the market is so very, very huge, nobody needs to do anything which is irrational. No one needs to do anything which would, hurt the sector, because the growth is there for everyone to have. So whether it is employed category, self-employed category, of course there is competition. But notwithstanding the competition, we have, if you take the last 10 to 12 quarters, you will see that we have consistently grown at a pace which is faster than what the system has grown. So we continue to get market share.
So if you're talking about loan growth, right, or AUM growth, is it something that you can sustain? I mean, the growth has remained very healthy on an average of around 12 to 16% if you look at the last 6 quarters. And in the quarter gone by, it was about 15.5%. Is this a level that HDFC can sustain even in the early part of the new calendar year?
Sonia, when you talk of growth, you should not look at the balance sheet growth. You should look at the growth in the individual loan segment. If you look at the individual loan segment, our growth has typically been between 15 and 18 or 15 to 19%. Last quarter was higher at between 19 and 20%. So look at the individual book, don't look at the non-individual book. Why you should not look at the non-individual book is because this tends to be very volatile. If you look at the breakdown of our lending today, roughly 81% of our loans are to individuals, roughly 9% are for construction finance, and the rest is corporate loans and lease rental discounting loans. Now, the construction finance book did see a slowdown in terms of new projects getting launched between 2017 and 2020. Now, typically a construction finance loan takes time to disperse. So it's not like a corporate loan where you disperse the entire amount up front. In a construction finance loan, the disbursement is linked to the stage of construction. So as the developer keeps building, as he keeps constructing, we keep dispersing. So disbursements tend to be back-ended. So because between 2016 and 2020, not many projects were launched, we did not do too much of incremental approvals in that period. Those are the kind of loans which would get dispersed today. The pickup has come from 21-22, but that pickup will only get reflected in the loan book over a period of time, because first the developer has to put in his equity, then he starts constructing, and then we disburse money. So look at individual loans. So if you look at individual loans, a 15 to 20% growth is what we've seen for a very, very long time, and I feel extremely confident that that growth momentum can continue unabated for a very, very long time.
All right, so that question answered. Then let's talk about the interest rate scenario right now. I mean, if we just take a look at your net interest margin and spreads. Spreads in the previous quarter were lower by almost 4 to 5 basis points. Net interest margins too, from 6 quarters away level of close to 3.7 have come to around 3.4. Do you think they've stabilized here, or there's some way more for them to narrow going forward?
If you were to look back at what we told investors 6 quarters ago, we said that the 3.7 is a bit of an aberration. And even at that time, when we were giving our results, we said that our normal guidance is between 3.3 to 3.5. So we feel confident that spreads would remain in that band of 3.3 to 3.5%. I'm not talking of spreads, I'm talking of net interest margin. So net interest margin should remain between 3.3 and 3.5. And spreads, I think the 2.25, 2.27, 2.28, I mean, let's not get into 1 or 2 basis points here and there. 2.5 to 2.8 is typically the level of spreads we've had for a long time.
So there is no hit on demand that you are expecting because of the rising interest rate situation, right? I'm asking because most developers tell us that generally there's no correlation up to a certain point. But now interest rates have been rising for a while. So do you see any impact on demand at all, either affordable or premium?
See, Sonia, what happens is when interest rates go up, sentiments do get impacted. Economically, it does not really make too much of a difference because no one gives fixed rate loans today. Everyone gives floating rate loans. When you're giving a floating rate loan or when you're taking a floating rate loan, it really doesn't make too much difference where interest rates are at the point of time when you take a loan, because interest rates move in cycles. So you will have cycles of rising rates and you will have cycles of falling rates. And in a 15-year term, typically, which is a housing loan term, you will have 3-4 such cycles. So it really doesn't make much difference whether rates are low or high. But yes, sentimentally, it does have an impact. Typically, what we've seen over time is that when rates are increased for the first couple of weeks, there is a bit of a slowdown in terms of new applications coming in. But by the time a couple of weeks are over, people just get adjusted to the new interest rate environment and the momentum comes back to what it used to be.
Just a bookkeeping question. The merger date or the merger timeline for both HDFC and HDFC Bank stays on course, right? I mean, when are we looking at the record date, etc.?
Typically, we had said that around June is when we would expect everything to be completed, and that remains on track.
All right, Mr. Mistry, thank you very much. Great speaking with you. Appreciate you joining in. And season's greetings from all of us here at CNBC-TV18. Thank you. Thanks very much.
And one Merry Christmas to all your viewers.
Thank you, Mr. Mistry.